Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. Nothing here is a solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. And welcome to the Special Situations cast. My name is Bram de Haas, and today my guest is Mike from Non-GAAP. This is a very cool newsletter where he's focused on the dark arts of corporate governance. He researches changes in executive compensation, off-cycle awards, and he finds really cool signals that say something about the outlook of a business. And you also learn a lot about corporate governance in general from him. Welcome, Mike.
Thank you. Thanks for having me.
No, I'm so glad that you were able to come on. So much fun. Let me first ask you, can you tell the audience a little bit about how you got into investing? And you've got a real cool background at a activist shop, I think.
Yeah, so, before I did this newsletter, which, it's not even really a year old at this point, in a past life, I spent about 10 years on buy side, 8 years focused on kind of the activist investing style. I worked at a fund called Relational Investors out in San Diego, California. We managed about, somewhere around 6 to 8 billion at the time. This was the mid 2000s.
How many people?
I think the research team was. It was a concentrated portfolio, but we actually had like a lot of analysts, per name. So like I would cover maybe 2 to 3 names in the portfolio, as far as like positioning, and we only had like 9 to 12 names. So very, very like concentrated, very, at least at the time, very like value and cash flow centric, and that strategy kind of evolved over time. But we, at the end of the day, we tried to find, today we call them compounders, but back then what we were trying to do is find these great franchises with great cash flow characteristics, and for one reason or another, it would be, there would be a discount that we thought that we can play a part in unlocking that value. And did that for about 8+ years, and it transitioned from that to do more technology and software development, and then I think most recently I started doing a newsletter. So it's been an interesting path. Happy to discuss all sorts. I think I've pretty much done every type of value investing style you could think of, from small cap deep value to even kind of the borderline growth type companies. Cool. It's been definitely an interesting journey.
Yeah, and I'm so curious about I've noticed that a lot of the larger activists, they tend to go for like the quality companies. I think it's because if the small ones can go for like micro caps, and those are there's not as much quality, but maybe there's a lot of value to be unlocked by making some sort of big changes. But then I think it's in the large caps, it's really annoying if your position starts sliding, just because it's a cyclical or something while you're doing your activist job, and then at the end, you're 6 months in and you've made no progress.
It's definitely an interesting difference. I would say like small and micro cap activism in general tends to have a lot more like hair on it, so to speak, right? The assets might not be as good as, and there's a reason why they're at those valuations versus like the mega caps or large caps. But it tends to be a little bit more hair on the assets. The management teams are a little more willing to kind of push the envelope, fighting back to a certain extent. Whereas I think in large caps, what's interesting, or at least back then, you had these like great franchises that for one reason or another would have genuine, real, sizable discounts that, maybe let's say like 50%, intrinsic value discount, right? And it's like, whoa, like this is a really good franchise. What's going on? And then you figure out, okay, the market is essentially valuing their incremental cash flow at a negative value, or they're basically saying this management team is lighting their capital on fire, right? And it becomes a capital allocation agenda or story. And you work with those management teams to recognize, hey, you have this great franchise. It's allowed you to pursue some of these more aggressive opportunities, which is great. We want you to pursue them, but to a certain point, if you're not generating results, market's going to start valuing that in. So I think that's the other thing with quality companies is you're given more leeway to take those risks, and you can get away with it for years, if not decades, potentially, until the market just goes, no more, throws in the towel, and then that's when we can step in and go, we got to kind of get back to basics and clean things up.
Oh, so that's super interesting. So there's like with, I mean, to an extent, like maybe Alphabet has been somewhat of an example of that they were doing so well. And then, there were a lot of questions with investors on what they were spending it all on. And I mean, they fixed it themselves, but to an extent.
I would say they are, arguably they have one of the greatest business models in the history of business, right? With AdWords and search. And tech's a little bit interesting. There's kind of a couple dynamics at play there. You're actually incentivized to try to keep your margins disguised or low to some extent, especially as you ramp, because you're either going to catch the attention of your competitors or you're going to catch the attention of the regulators. If your margins are too high, it's kind of like the opposite of how they train you as a value investor as far as like high ROIC, high margins. It's like in tech, you have to find companies that have those characteristics with the potential of super high margins, acknowledging that you can't show that, right? It's almost like you have to keep a poker face on your business model or people are going to pay attention. I mean, to some extent, maybe Google took it to the extreme, as far as experimentation, but I mean, that was their DNA. That's how they got big in the first place, right? Kind of that, collegial, academic, long dated kind of R&D projects. So it definitely is a friction, but you're right.
It's absolutely a great company, but it's why I picked it. It's like at some point it got a little bit of a victim of its own success. Like it was doing so well, it could afford to do all that, and was still doing well. And
what's exciting now is I think with the new CEO, I'm probably going down the rabbit hole here, but like going into, so one of the things we do in activism to help kind of improve the story and narrative is better disclosures and almost shining a light on the key issues to drive accountability. And I think they're partly forced to do this, but as the new CEO kind of takes over and they actually disclose the business units and how they're doing and kind of some basic revenue and margin characteristics, like don't underestimate kind of the impact of that as far as driving new behaviors within these organizations. So it'll be really interesting to see how kind of that plays out going forward, given, like you said, all these experiments are finally seeing daylight.
Yeah, well, when Roof Parat came in, that made an impact over time. Mm-hmm. It was maybe a little bit like a friendly activist from the inside, but I think that already had a huge impact. There's something else I've learned from you, that when activists are silent, things are going pretty well. You're making progress with the management or company, and it's actually when the decks come out that there's a lot of resistance. And I thought that was very interesting because the decks attract a lot of attention, and I think that's when a lot of people think, oh, I'm going to back this, or
yeah, I mean, I think activism at its I don't know how to describe it, but when you're doing good activism, it is behind the scenes. It should just be kind of a partnership and building consensus, or at least building some agreeable direction and getting that done without a fight. And you just introduce a whole host of frictions and um, other challenges when you have to do a proxy fight or you have to go public. It becomes kind of a different engagement. It's in a lot of ways it's very similar to just running a portfolio, right? When your portfolio is doing well, you just kind of set it and forget it to a certain extent. But when things start blowing up or there's volatility, then you have to ask yourself, did the thesis change? Do I want to put more money to work? Do I need to double down? Do I exit? Like that, when things start going in the other direction, that's when a lot of the roll up the sleeve starts kicking in. And that's I see that's very, it's an extreme case in activism because they're actually getting in there, but it's ideally you never want to deal with a blow up, but if you do, expect to get dirty trying to fix it.
Yeah, it's well. And did you ever go on a board, by the way, or were you too young at the time? Or
so the way we worked was the partners went on the board, so there were kind of two senior leaders that kind of drove the agenda, and we as analysts basically were the backbone of. We'd come in with the idea, we'd kind of frame what we need to do, the agenda, literally did all the high level work, but also like dug in the footnotes and then presented a plan that they would implement. And then when they were on the board, we were responsible for essentially going through all the board documents, doing the analysis, and really flagging or identifying issues for them to communicate. So the way I think of it, and the model, like unsurprisingly, is based on kind of politics where they're kind of the leader, and you have kind of a political war room, so to speak. Doing the breakdown, right? Yeah, staff, like what's sentiment on voting, what's like it's kind of like you're like a chief of staff almost. So you're in there, you're exposed to everything, but you're not the one actually in the seat. Which it's as a fly on the wall, it's super interesting.
Yeah, no, I would prefer to be to not be in that seat.
Yeah.
Well, maybe your firm style, that's okay, but I think from time to time you got to bring the hammer.
Yeah, it's you definitely give the plan, and my favorite part was kind of the post meeting breakdown where you actually get to hear like what in the world happened or how they reacted to certain things. It's you also get to sit in on like some calls and experience it yourself, but it's definitely kind of a sometimes, especially in activism, very larger than life type theater, I guess, for lack of a better phrase, playing out. It's pretty fascinating. But yeah, cool. I definitely was not something I thought I could do or want to do, I guess.
Just came across your path, sort of. What was like the coolest campaign that you worked on or that you enjoyed the most?
That's a good question. I think each campaign kind of you learn something different. It might not necessarily be the coolest, but like it sticks with you. So like my first project was with a regional bank called Sovereign Bancorp out here in the Northeast U.S. And this was like going into the financial crisis. So we got to basically get kind of a front row seat because we were on the audit committee too of literally this. I didn't appreciate it, but it was like a once in a generation kind of like, oh my God, this is actually happening, at a bank, mm-hmm. from their perspectives. And given that was kind of my first big, project when I started there, it just kind of, it sticks with you. I think more generally, like my favorite project is Intuit. For a bunch of different reasons. That was kind of the first one where it was really my own, I guess, name that I got to finally, come up myself and pitch and get someone on the board and work with the company. So there's that. It was like, it's kind of like that first time when you finally move from apprentice to actually like trying to do it yourself, which is cool. And the other thing too was
No,
This was
I'm
coming
sorry,
off.
because Inuit, I don't know the company.
Oh, Intuit. So they sell like QuickBooks and TurboTax and
Right.
like small business software, accounting.
Is that a
Um,
spin-off or something, or?
no,
Oh,
they've been around for quite some time.
okay.
They did Quicken, but that was the coolest. So that was the coolest engagement because we were on the board, and that was really the first time I got to learn about running a software business like from the inside and from the I'm not going to say I had operator role, but getting more of an operator's perspective through those board documents and discussions and and we as investors talk a lot about taking that owner's perspective and how to think like an owner and thinking about the long term. But I think that was the engagement that actually forced me to kind of appreciate and critically think through, well, what does that mean from a company perspective? How is that actually communicated? How is that actually planned? How is that coordinated? How do you course correct when things are going wrong? So that was really the coolest experience because you got like the true
And
360
I'm sorry. Okay,
exposure.
maybe how do you mean from a company's perspective, like how you could get that attitude into management's head or into the whole organization, or maybe how that were they looking at their ownership or stakeholdership a little bit different?
I would say it's more in the context of when you value or invest in a company, where you're doing research on your product, on the unit economics, and even like the capital allocation to come up with a view of the company, and then you decide to invest or not based on your assessment. When you're on the inside, you have a direct channel to actually communicate what that means, right? Like, it's one thing to say this is a good product, this is what they do. It's another thing to be in there and actually try to understand, well, why is it a good product? What drives the stickiness of this particular product versus some other competitors? Why have we been able to do well when, say, a big tech company like Microsoft comes into the market? You
Right.
start
So
learning those you actually get exposed to actual tactics or actual like implementations, right? It's like, it's one thing to say improve your capital allocation from the outside. It's another where it's, okay, well, let's work on your planning process. What's your plan? How's that translate to ROI on certain projects? Like, you're getting in there, and it's definitely something you don't really appreciate as much as an outside investor, even if you're doing all this work.
cool. So that really felt like you were maybe part of the company, or at a executive level inside a company. And it was also a software company, and your firm, it kind of wound up at some point, and that's when you left, I think. And
I left a few years after, so we got involved probably 2009, 2010, and exited a few years after that. The firm basically started winding down around 2014, 2015. One of the senior partners got sick, and kind of a key man provision, they decided to wind down the fund. So yeah, it was probably a few years after the
and
Intuit
then
experience.
that's when you transitioned into a career in tech, right? Or
Yeah, so I mean, one thing at least for me, when that happened, as far as a partner announcing he got sick, you start kind of thinking about your own kind of life and what you want to do and try different things. And that was just kind of a point where I really enjoyed kind of the operational side, the tech, talking to engineers, and I've always been curious about software, so I use that as an opportunity to I mean, it's kind of a cliche, but like, I learned to code and learn how to build sites. And
that's not a cliche to me. It's not. It's cool. And
and it was I was gonna say it was a great time, great experience, and it was a great way to recharge my batteries before I guess kind of go organically going back into investing, so to speak, with this newsletter and things like that.
Yeah. And I think if I started reading your newsletter maybe a few months back, and you've been writing it for quite a while. And at the start, I felt like maybe you were writing for tech people about investing. And slowly you got more technical, and I think now you've got a lot of finance people reading it, but I could be totally mistaken.
I think it's been an exploration. I started with writing about what I found interesting, and I'd like to go back and write some more tech stuff over time, but I think it's kind of a feeling, it's kind of a feeling out process, trying to see what works.
Sure.
No,
What
but
interests me. I mean, like it felt to me like at the start you were almost writing for like you got maybe questions from people in tech about investing, and that you were answering from coming from that mindset. And well, I think you've really had a super cool groove with your governance focus, but that's a little bit different. And I was just curious how that evolved, if that were true. And I have to say you're a really great writer. People should definitely check it out. I think they can. You've got free subscriptions, right?
I have I have two tiers. I have a free tier, which usually is focused on high level concepts and just the goal is to give you something you can take away and hopefully improve your own investment process, or kind of elevate how you're thinking about things. And then I have a premium tier, which is more real time, so it's less retrospective and more like, hey, this looks like something that's forming, or this is a situation to spend more time on, pay attention to. And I mean, if it works out, they tend to be pretty interesting stocks to look at. But either way, I always try to make sure that you try to pick up or learn a concept on every write-up, even if it's a company that might not interest you in general. You should be able to take something away from it. At least that's always my goal.
Yeah, I think you do a great job of that. You're really, really great writer. I don't know when you learned that, but it works. It's casual, but it's. I mean, there are no cliches, and yeah, it's really terrific.
Well, I appreciate that, just because I've always considered myself a average or mediocre writer. So it's been kind of a interesting experience. I mean, I actually started writing this as partly to try to improve my writing. It was a forcing function. So appreciate it.
No, I really think you're doing fantastic. It sounds like you're talking to me, and it's funny, and I'm learning a ton. So it's really, really natural. Something that I wanted to ask you is a little bit about, so I'm very curious how you invest, or what's your investing style, because you are interested in really different ideas than I am, and some of them are very specific event driven. It can be something that's going to happen in a couple of months or something. So I was curious, how do you actually put that in practice?
I would say my style, when I think about it now, I probably bucket it into kind of two general areas with an overlap. So one bucket would be, and it's nice because I think Microsoft has this interesting M&A kind of philosophy that I agree with. So I in one bucket, I tend to look for kind of communities, network assets, network effects, growing markets, things that you probably would attribute to technology companies and network effects companies. That's kind of an offshoot of my time looking at tech companies as well as that relational. I think one of the things that a lot of my learnings in investing actually came from studying companies that we never invested in, incidentally, and this was kind of a recurring theme. So that's one bucket, and then the other bucket, and this is more directly tied to the governance. The other bucket's event driven, right? So governance, activism, anticipating incremental steps, very classic, like, I mean, spin-offs, right? All the things that I think most event driven investors think about. It's fun to look at those things, right? It keeps me busy from touching the other part of my portfolio, which is more longer term, community centric, networked assets. And then in the middle, I love businesses going through inflections, right? Going through a transition, whether, I mean, it's popular now, but back then when that transition from perpetual to SaaS software, or a company that's been wholly focused on product, and now are starting to introduce monetization into the so like Tinder, getting monetized, right? Like those sort of inflections always kind of appeal to me. And it's also other inflections would be governance related, right? Maybe there's a wholesale change in strategy, in capital allocation. I consider that an inflection that can be thesis changing. So it kind of ties into those two worlds. But so that's kind of how I consider my investment style. So if I were to kind of break it up, I would say probably 2/3 to 80% is more of that passive kind of growing markets, networked effects style. And kind of longer inflections or mega trends or whatever you want to call it, and then that 20%, that sandbox is kind of that like creativity, that like being in the markets, being able to find interesting opportunities, and making calls, and by keeping by keeping myself busy in that sandbox, I leave the rest of the portfolio to do its thing, so to speak.
Sure. Yeah, I'm probably not doing too bad. So, and I mean, some of the things that you write about, they're like, it's almost like they're invented for options or something like that. Do you use those, or you stick to equities?
I will do some options every now and then, but very small, more like I treat it no different than if I were to go to Las Vegas and go. Like, it's money I'm willing to lose to learn, or to kind of understand a situation, but it's mostly equities. Mm-hmm. What I've learned is when you governance investing, what does that even mean? I think at its heart, in the event-driven world, what you're trying to do is anticipate and recognize behaviors by management teams that indicate there's something much more material, or whether it's accretive on the upside or even downside, and use that signaling to try to find mismatched prices in the market, right? And there are certain signals and behaviors that tend to consistently create these sort of trading opportunities.
Yeah, maybe please give some examples that makes it I mean like examples of like signals that you like, because I think some people have never looked at a proxy or what's actually in there. I mean, a lot of people know about insider buying, but I think even that gets underestimated sometimes, or not differentiated. Like some insider buying is a little bit more interesting than other insider buying. But to get back to your subject, yeah, please give us some examples so that we know what you mean.
So I like to I try to make it like as accessible as possible. So the way I think of it is, it's no different than when you're looking at a company or an opportunity and you're an investor, right? And and you're following the name, you kind of have a good feel for the strategy and cap allocation, and you're really bullish on it. But let's say hypothetically you're in a stock and it blows up, right? What are your options at that point? You either you sell or you capitulate, or you can potentially buy more. But the other thing too is if the stock blows up and you do more work, you also ask yourself, well, is this a thesis changing event? Do we need to change kind of our direction in terms of how we approach our go forward plans and things like that? And then is that worth, doubling down a position on? From management's perspective, they're thinking the same things we are, except they get to express their bullishness in different ways. So in the case of, like, let's say they think there's like a lot of upside, they can work with the compensation committee to load themselves up with equity after a stock's blown up, right? Because they think that their new plan is going to generate a tremendous return, so they want as much option and equity exposure as possible, right? Like that's one lever. Or if things are going to go bad or they're going to blow up, maybe they have some equity that they're going to get, but they're going to tell the board, you know what, hold off on giving me that equity until this news comes out, and give it to me afterwards so I can get it after the blow up. The opposite, which is pretty popular, is called spring loading, which is, I know good news is about to hit. Give me as much equity now before we have to announce it. And what's funny there is, if you bought stock, that's insider trading. If you were in possession of that, like, they wouldn't be allowed to buy the stock. But for one reason or another, and they don't crack down on it, if you can convince the board to just give you the equity as part of your compensation process, you're usually okay. Like, you don't usually get prosecuted. People don't really pay attention. And it's like, it's funny because, I mean, you've seen it firsthand. A CEO can buy $10,000 worth of stock and people go crazy, right? Insider, like, this is great signaling, but it's not, it's okay. But a CEO can ask for 10 million shares before, like, earnings, and no one will pay attention. It's like, this guy just loaded himself with equity, like, to like, just up here, and the stock isn't even reacting. Like,
Yeah,
there's intent behind that.
Admit that before I read your newsletter, I didn't realize that this happens so often. And I think in, like, the grand scheme of things, maybe it's not the hugest of deals. That's why it probably doesn't get cracked down on, but it's pretty tacky. And because the spring loading is really, they know something is going to happen, then they get themselves options, and they must feel pretty bad. Like, you're asking your board, like, give me some extra options at this time.
Well, I mean, so the reason I spend so much time looking at proxies is that's where you get to see the personality of management and the board and how they behave. And you can kind of tell, like, certain management teams have a lot more power and control than other management teams, just based on their granting behaviors or how they do certain things with their compensation hurdles. You just kind of pick up on that.
But are probably also, like, people who think this is too tacky, like that they, or
it could be, but I think it's, so the way I think it's a puzzle, right? It's like, listen, insider buying is a very straightforward, like, signal. This is like a Rube Goldberg machine trying to accomplish the same thing through a sequence of different, like, maneuvers at the board level to express, upside. And it's kind of like, yes, governance can be very boring to folks, but when you start studying those connections and those incremental decisions, it's like, wow, they really, like, took a lot of sequential steps to try to make this happen. It's kind of ridiculous sometimes, but also it's like, oh, this is kind of cool. They, like, you can actually see their thinking as they do this stuff.
No, I totally agree. Sometimes you really see the entire playbook, and the actions speak louder than any words. You have this observation that when things sometimes happen off cycle, is how you call it. So usually executives get, like, equity once a year or something, or options, and then it happens outside of that cadence, I guess. And you think that's really important, and I mean that seems logical to me, but that's pretty hard to detect, right? How do you notice that's, like, do you just, how do you know when something is off cycle? Do you always go back and look?
I think it's partly kind of spidey sense, just at least for me. I mean,
Okay.
when you spend 8 years looking at thousands upon thousands of proxies and programs and strategies, you just kind of pick it up. I don't think you need to do that to learn. I think in high level, just assume, okay, most companies have a December calendar year end, and most companies grant their equity kind of at the beginning of the year, right? For the go forward period.
A fresh start.
A fresh start, right? You get a fresh grant every year around, let's say, between February and March.
Yeah.
So anytime you see any sort of notable or sizable grants outside of that window, it's always worth kind of just like, you don't have to like do a lot of work on it. It's just like, what's going on? You know, like pull up the chart, like, oh, the stock blew up and you just gave yourself a lot of equity out of the blue. I mean, it's kind of technical analysis to a certain extent, but that's a snapshot of a picture that you're trying to figure out, like what's the story you're telling me here. So stock blows up, you gave yourself equity, and then you dig in. It's like, is this normal? Do you normally get it this time of year? It's like, oh no, it's not normal. Okay, what kind of equity is it? Oh, it's options. Historically, it's RSUs. So you're not only going off cycle, you're swapping into something that's levered to stock price upside. And then you just start painting a picture of like, well, what are some potential scenarios that could compel the stock to move up? And that's when the fundamental analysis kicks in, and again, like that's when it becomes like you're painting a picture, and before you know it, you're like, wow, like, okay, they think there might be an opportunity here. I mean, we can always walk through like a real example of that potentially if you like.
No, absolutely. Let's do a real example.
So why don't we do Party City, just because it's kind of recent and it's fascinating. If you're not familiar with Party City, so they kind of have a big presence here in the U.S., but they party supplies, right? Balloons, cards. They do like Halloween seasonal stores and things like that. Needless to say, COVID-19 shutting down retail stores, was a big problem for them, and they came from a private equity kind of IPO background, so they were heavily in debt, and kind of a genuine existential crisis earlier this year, right? The debt was kind of trading as a distressed asset. The equity was like $1 and change, is trading like an option. I mean, this was like very hairy, deep value, like distressed debt name at the time. And so given that context, you would assume as an investor, this equity actually might be worthless right now, right? It actually might be something that you don't want to have any exposure to this year until things stabilize and they actually get some liquidity, and there's like real proof that they're going to be okay. I mean, it's still trading pretty darn low, right?
Yeah, it's like an equity stock, like Joel Greenblatt talks about sometimes.
Yeah, I think it's still like a $2 and change stock, so it's still kind of like not necessarily out of the woods right now, and they shouldn't be.
No, but I think it's like doubled since you wrote about it first or something.
Yeah, so I wrote about it. I think probably in August when it was like $1.25, $1.50, and so what caught my attention is distressed companies in general, executives, when things are going sideways, they shift to cash compensation. And you see it all the time, right? Like cash bonus ahead of bankruptcy filings all the time. So when this CEO, and he's a new CEO too, when this CEO, normally you get your equity at like we said at the beginning of the year, they held off because of the crisis. That made sense. Seemingly out of the blue, they decided to give them equity compensation in the summer when the stock was single digit. And I think the first thing that like caught my attention at the time was, this is weird. Like this thing's traded in like I said, like stub, like it's going bankrupt potentially, and you just loaded up on what was it? Okay, 2.9 million shares of equity. Like this was like a massive grant. Like so that caught my attention. Like so you went from like cash which is safe to this highly speculative equity, or at least the market was pricing as speculative. The next step was to look at the grant, and we go to find out the vesting schedule was tied to price appreciation. So like the various tranches was like, it was like $2.50, $5, $7.50, up to $10. And I was like, the stock is trading at $1 and change. And you like, in order to hit your last tranche, it like basically has to be this huge multi-bagger. Like
Yeah, it's
this,
like life-changing money for even for like established CEO.
Exactly. And it's like, this is a brand new CEO. He agreed to these hurdles. So now you start thinking, these are life-changing hurdles. You have to have some confidence that you can hit it. Like you have a plan in place. You have comfort that the core business isn't going to go bankrupt, or, you know, the equity isn't going to go bankrupt. Otherwise you wouldn't agree to that. So this is kind of playing that triage of like, okay, this guy is very bullish. He's willing to maximize his equity exposure when everyone thinks this thing's a distressed debt play, and he apparently has a plan where he has confidence to theoretically hit $10 a share at some point in the future within, let's say, the next 4 to 5 years. You kind of piece that all together. It's like, I don't know if he's going to be able to hit that plan or not, but at the very least, I know that they have confidence. They have confidence that that it's going to be a going concern, right? Like the stock was priced like an option, and it's so distressed that it was like, I don't know if they'll hit $5 a share or anything else like that, but I do know they think that they're okay. They're kind of out of the woods from a bankruptcy risk perspective. So go ahead and consider like even like a toehold position. And yeah, you know, long story short, a month later, I think sentiment's shifted, and it's gone from $1.50 to nearly $3 a share now, and it's you know, a couple more quarters of positive, you know, news, and maybe, you know, a reopening starts happening. Maybe the $5 scenario starts kicking in. But that's kind of how I think about these things in real time, you know, with kind of a real example of compensation and governance.
Yeah, I mean, it's a pretty cool situation. I think there's like at least a few new people on the board.
There's turnover. There's a transition, right? There's new people coming on.
Yeah, and there was like some bondholders, and they were converted to equity, and I think those are like selling. Like a lot of them, there's like a sales program, so that may be a little bit of an overhang for a little while.
But at the end of the day, they're operating for the next kind of stage of their company life post-COVID, right? Like they're bringing in new governance, they're cleaning up the ownership table. You know, we'll see how it goes, but
yeah, there's a lot of insider buying too, like besides those. And then I was curious, like, do you think there are like any asset sales possible? Because this was, to me, this is like typical. If they, you know, can clean up some assets that you know, are currently not recognized, that changes things really fast. But I wasn't sure.
I think that's a possibility. I'm not sure if that's something on the table. I think the other thing too is like people attribute them as kind of a retailer, but really kind of the core and heart and soul of the business is they kind of have this like really great wholesale balloons business, right? They kind of, you know, they like kind of own that market, and people don't realize that, yeah, they have these stores, but they also get, you know, supply the balloons and helium for a lot of other retailers and entities. So
it's also why they really struggled, right? Because like a year ago or something, they were constantly on a helium shortage or something.
Yeah, it was like a helium, but apparently that's past them, and that's like still a great business, and you know, from a operations perspective, the new CEO I think comes from Petco or something like that, and I mean, if you've gone into a Party City, it's kind of a disaster, like in the past. And now you have this new guy that's going to put in hopefully best operational practices at the store level, who should help productivity and kind of investing in the store, which could be interesting. And like in the past, one of our positions when I was at Relational was Home Depot, and part of our agenda was not only capital allocation, but hey, let's start reinvesting in the stores again and bringing back kind of the core values that made Home Depot really good, and invest in headcount and customer service and things like that. And we might see something similar with Party City. I mean, on a much smaller scale, like let's invest into the business. So I mean, we'll see, but this thing's still priced, with some real risk, but all the insiders behaving like we're working towards the next stage of our company life. So we'll see if it happens. But if it works out, I mean, could it be another double again over the next year? I mean, maybe, possibly.
I mean, it's a super interesting idea. I don't mean to criticize too much. Just some of my best investments have been like where some distressed real estate fund, and normally they're always taking cash salaries, and there's like the mortgages, they're not provided by banks anymore because it was total mess. They were provided by like specialized hedge funds at 14 or 12% or whatever, and suddenly executives all taking entire salaries in equity,
Yeah.
They're not taking any cash. I'm like, okay, I like the valuation, but now I like it a lot more. And
I think that's the key to being good at doing this. Like you shouldn't necessarily rely 100% on governance, but if it helps elevate your existing research and due diligence, and maybe you're on the fence, right, as far as should I size up or really get involved, those sort of actions combined with the existing work you did, it really helps, right? It can help you like de-risk some of your concerns and can actually like elevate certain things that maybe you're bullish about, and that's what I try to evangelize when talking about this stuff.
No, but you get so much out of those proxies because you really elevated my consciousness of like what's possible, what you can find in there. Because, it's not that I never looked in there, or that some things I'll notice like those salaries, but you really get a lot out of it. Maybe there's another company I really liked. Maybe Vaxarts. Maybe.
Let's talk. Yeah, let's talk about Vaxart. I think Vaxart's pretty cool, especially for like the event-driven investor, because it's such a unique situation, right? So they did their biotech focused on kind of oral vaccines, and that kind of development, and like intuitively, I guess for me as a consumer, if I could choose between just ingesting a vaccine or getting a shot, I'd probably want to just go to my pharmacy and get a pill and get the vaccine. So a vaccine pill. So that's great. What's interesting here is, I'm not going to get into a lot of the kind of details, but they brought in a new CEO who was a director, a board member at the time, to take over. And he didn't really have like so one of the things that stuck out was he didn't have a biotech or science background, right? He was kind of a business, commercialization, partnership background, right? That stuck out. So you bring in this guy in June, and then you give him,
especially it's just a small company. It's really early
small
stage.
Company.
Yeah,
early stage, kind of heavy insider control. You bring in this guy that's more commercialization based. So immediately, if you follow the space, you're like, okay, like this is a more transaction centric CEO. That captures your attention. The next step is, what's his compensation package? And this is what was really cool about this one was he basically had options tied to a few things, but one of the things was there was a price-based investing component to it that was like really deep out of the money stuff, right? Very similar to Party City, where it's like, I want to say that stock was, I'm going off the top of my head, so forgive me if I'm wrong, but I think it was like $2 and change at the time the stock, and like the hurdles were like going into like $8 or $9 a share, right? Like significant stuff.
Yeah, and like deep out of the money options are really rare for executives, right? I come across it.
Well, yeah, well, yes and no. There is some good usage using kind of price-based hurdles to drive incentives. You usually see them when
staggered or something.
Yeah, yeah. You usually see price-based vesting, especially out of the money when it's a new CEO or there's some new change in strategy, or usually there's something significant attached to it. So whenever you see a grant like that, spend some time understanding why it would be granted in the first place. So for this guy, multiple tiers. I think what stuck out, obviously, that signaling that there's some viable path to those valuations. But what really stuck out to me is two things. Traditionally, when it comes to change in control, there's this concept of double trigger vesting where, okay, there's a change in control, that's one trigger, but you're not going to get all your shares vested unless like you lose your role, you get fired or something else. Then you get all your equity. Otherwise, you continue vesting within the role you have. This particular grant removed that best practice of double trigger and went straight to single trigger vesting for a transaction. So that right away tells you we have a guy who specializes in transactions and doing partnerships, getting equity that's out of the money, that's single trigger vesting. Like you start kind of putting these fact patterns on top of each other. It's like they're incentivizing this guy to do a deal potentially, or there's something brewing that is incentivizing him to do this deal. And then I think the big scream, like if you pull up that option grant, the big screaming thing is that price-based vesting, they granted his equity options in June. He was supposed to get all his, I think, shares vested. He was supposed to hit $9 a share by November of this year. It wasn't over several years. Normally you get like 4 or 5 years. It's like, okay, here's your vesting schedule. It's price-based. It's up to $9 a share, and you have until November of 2020 to get it done. I was like, this is a screaming event-driven, like crazy, like what is going on type situation. Then, a couple weeks later, they announced like positive news flow around like their COVID vaccine and being part of certain government programs. Stock popped, and I think as high as $14. But
so is it then more of a spring load, or was it like it's a lot of things, but it was a mega spring load signaling like an event driven transaction potentially by the end of the year. I mean, we're in the end of September. For all we know, they might they might still announce a transaction partnership within the next month, for all we know. That the risk, or no, the opportunity there is probably removed because the stock has popped so hard on different news flows, like tied to their vaccine, that it's like all those shares are already vested because the stock has high as I think $14 a share. Right.
I mean, it's come back to like $6 or $7 a share, but I mean, so like like this massive grant that he got in June is already for the most part invested, which is crazy, but that's one way to look at it from an event-driven perspective. Like, what are the parameters of these unique one-time grants, and what is the signaling, or what's the messaging there as a result of these different parameters?
Yeah. Yes, super interesting. And so one thing I wonder when you were telling the story is when they typically set those vesting schedules for executives. Mike, do you still have a few minutes, or?
Yeah. No.
Okay.
Mm-hmm.
Are all the targets like achievable, or are CEOs also sometimes like, oh, just give me some targets and I'll probably not hit them, but if I hit them, I'm making big money? Or
this is where the push and pull of like corporate governance comes in, right? So if it's tightly controlled, or if like the CEO or leadership and the management team has a lot of influence, and most have some degree of influence, like those hurdles actually might be highly achievable. So that's a good signal, right? Like, on the other hand, maybe there's an activist on the board. Maybe there's real accountability. There's like directors that actually are challenging these management team, and these are actually truly at risk hurdles. They're actually truly like, you got to put in the work to hit them. That's another signal. It's like, this isn't a slam dunk, but this also potentially signals strong corporate governance because of like who's there and the checks and balances there. So that's where you kind of have to dig in a little bit and go, we have these deep out of the money price hurdles. What is it telling us? Like, is this a guy that has control of the company, and this is just his way of trying to maximizing value because he knows he can get it because he has good news on horizon, that spring loading dynamic? Or is this a dynamic of, hey, things are tough, we want to make sure you get paid, but we're going to hold you accountable, and like it requires real execution to get this payout. So you definitely have to do some homework there, but that's where it's, again, this is where you get into the nitty gritty, and it becomes an interesting research project.
No, that's fun. And like you were saying, I get this idea that if you know somebody is spring loading a lot, that you just follow that guy or a girl, and then really watch out for when he's getting another grant. So this sort of repeatable behavior or something that.
I mean, spring loading is interesting because if you can find someone that practices it, you can. I mean, basically once a year, you can just kind of watch and go like, are they granting before or after earnings? What's going on? And I mean, I'm probably
they really vary every year.
Yeah. Okay. Yeah. I mean, I may be arbitraging myself on certain people, but when you find someone that behaves a certain way, you follow them, right? Different companies or the same company, and this goes into that bucket of 20% event driven. Like once a year, if you can get a handful of spring load situations, you might not hit all of them, but like, hey, if you can find a stock that's moving potentially 20 to 30% within like a 30-day timeline, I don't like using IRRs, but like you can like get some really nice returns over a quarter just playing in that sandbox potentially. You're not going to hit all of them, but from a portfolio perspective, if let's say you found potentially 10 or 15 spring loads, and maybe some of them fizzle, some of them are blow ups, but a good chunk of them, or majority, are good. I mean, it's an interesting strategy. I'm surprised more people don't actually try it as a strategy, but maybe they just weren't aware of it.
I think that's definitely part of it, because some of it is pretty complicated or not so easy to detect unless you were really engaged, like with your activist background. But even I'm pretty interested in M&A, and so something I've noticed is that they can buy when they're being acquired, but they stop selling. So it was pretty hard to detect, but I think it's definitely the case. And it's
that's probably the most nuanced, very like hard to find high signal ones, is you suspend the 10b5-1 selling or things like that.
I was wondering about that, if that was legal at all, like stopping your
I think so.
Okay.
I think you can. I think the more interesting signal, and I wrote about it, like if you guys want to check it out, about GoGo.
It's a recent free article.
Yeah, it's a free write-up. It's about GoGo selling their commercial aviation business, and just kind of the strategic alternative signals communicated through their equity planning, and tying that to management commentary, and just kind of the industry dynamic. And I try my best to try to walk you through my crazy as far as how I looked at it and think about it. But that, that would be an example of kind of using equity as a way to signal, okay, maybe there is a deal brewing here potentially, versus just simply pausing the 10b5-1 plan, which is hard. And you can do it, but it's I think they're easier games to play in governance.
Mm-hmm. No, I just like it as a additional thing to look at.
Oh, for sure.
And sometimes they do a lot of selling, and then it's more noticeable. Yeah. So this GoGo was a interesting situation. They do like Wi-Fi in airplanes, right?
Yes. So, I mean, if you've ever flown and tried to log into, Wi-Fi on a plane, there's a very good chance, you went through GoGo's network and equipment to pull it off. I mean, historically, they've run two businesses, right? Commercial aviation is one, and then business aviation is the other. So business, I mean, they're basically selling Wi-Fi equipment and connectivity to private jets. Commercial aviation, they're doing connectivity for commercial airline flights and things like that. I think historically, commercial has been considered a terrible business to a certain extent structurally. I mean, it's. I think they frame it as it's a great opportunity, but structurally not a profitable business. And for years, everyone said you need consolidation. We know we need consolidation, and the story or my write-up is focused on COVID-19 kind of facilitating or finally being that catalyst to get things done, and kind of the maneuvering management teams did, like going back to that topic of like inflections. How do you behave when you're seeing a change in what you're going to do or the outcome you're optimizing for, and the certain steps that you can kind of take to try to maximize your economic outcome. This kind of shows you how we're speculating here. We're trying to loosely connect the dots, but we're showing how, hey, COVID triggered the need to do strategic alternatives, and here are some of the things that happened along the way with these insiders to kind of maximize their financial windfall selling the company, right? Because they've been public for several years. It's been a very popular short with people, right? Given the structural challenges of the commercial aviation business, which also means they had a lot of deep out of the money underwater, well, not underwater options over the years that they needed to essentially reset to incentivize the management team to do something, arguably. So this is kind of the story I tell as far as what happened and why I think it signaled this potential transaction. Also,
I really like this
I was
one.
gonna say also,
because you basically wrote up the story because you saw like a lot of really great signals, but you didn't like the company. I
didn't like the company. I ignored my own signals.
Yeah,
I think that's the other lesson, is like being aware of your own biases, your investment biases, and how it is very important to, even looking at something you follow for years, sometimes you have to take a clean look at it, especially if signals are telling you should. And that was my big personal takeaway to that story. Because, I mean, listen, a lot of people flag that situation to me. It's like, and I would joke like, oh yeah, they're probably going to sell themselves finally, right? Because that's always been a recurring theme of like consolidation. I just like the boy who cried wolf, like it's not going to happen. And it's lo and behold, you know what? It happened. And I should have recognized it, because at the end of the day, changing your compensation is can be a very significant signal that things that people talk about are actually going to happen this time.
And did they do something else too? Like were there like two signals or?
They did option exchange, but they also got paid. The CEO got his cash bonus paid in equity over the summer as well. And then they also created a brand new bonus where they would get paid a bonus contingent on literally selling a business unit. They literally created a bonus for that and said, we're going to pay you a bonus. They filed it. It was in the filings. We're going to pay you a bonus if you sell this business. I'm like
a
ignored all
week
of that.
later, the process starts.
Yeah. So, the lesson there, at least for me, and to highlight, like, listen, I follow this stuff for years, and I'll ignore it myself sometimes. No one's perfect, lesson learned, but at the end of the day, this should help with your own process and continue iterating and evolving.
Yeah, no, but it's super hard if you've been short something or you really don't like a business, and then to take I always like to have a tailwind, even if I do something that's a bit more speculative based on some data points or something. I have an idea, I think it could work, and then you like to have the tailwind of, if it doesn't work, it's still a good business. It's not so much fun if it's if you hate the business, and that's much harder.
Yeah. I mean, there's also opportunity costs. Maybe it's better use of your time looking at different names, right? I mean, there were a lot of great names to look at. Like, yeah, I missed this one, but realistically, it'd probably be like a little, allocation within that 20% event-driven bucket that I like to play in anyway. So it wouldn't have been a big contributor to the portfolio, but like my personal portfolio. But this is a puzzle, right? Like, we love talking about this stuff, like with other investors, and it's cool to just, talk shop, and like, it's like, I missed this one, but sometimes you don't swing at fat pitches that, like, well, this wasn't 100% fat pitch, but like, I could have hit this one, and I didn't. Lesson learned.
Yeah, it's cool to read. Let's see. I thought I had something. Oh yeah, like a lot of things that you're looking at right now, they're kind of hairy with, and I thought it was like very different from what you were doing when you were activist investor with all those quality companies, and maybe those because it's maybe because you do a lot of inflections, then it just works a lot better, those executive compensation signals, and so that's probably why you get into all these kind of situations, right?
Well, I get into a lot of hairy situations. It's kind of like it's a curiosity thing. Part of it too is these signals are telling you that maybe the situation's not as hairy as the stock price is insinuating. And the other thing is, I mean, maybe at some point I'll write more about kind of the other part of my portfolio and kind of how I look at those sort of names, more longer term holdings. I like event driven stuff, like from a content perspective, because it's tightly packaged. I can like explain it. There's like a whole story you can tell, beginning, middle, end. Whereas like, we talk about some, like social network trend or, some inflection. Like, I might not be vindicated for years, right? Like, it's very open-ended. It's still super interesting to talk about, like to work on personally, but to write about. I mean, if people want me to write more about that, maybe I'll consider it. But in general, the event-driven stuff tends to be much more entertaining to write for me personally.
Yeah, and
it's easier for the readers to take away from it.
Absolutely, and I do the same thing because it's actionable a lot. Like, there's often something to do, and if you're subscribing to a newsletter, that's kind of, well, it's fun if you get an idea out of it now and then, and that's just much harder to do with the long-term compounders. Then you're just holding the hands of your newsletter readers from, oh, come on, we're just holding on, and
it's a long-term capex doing the more, the compounder type stories. I mean, you can write about them, but it takes years to play out. But I probably should mix it up at some point. It is I joke, I literally have I have this write up on Pinterest that's been sitting in my draft inbox since March. Now I have to like rewrite.
No, but
whole
I
thing.
really, I've read something from you on Shopify that was really good. I liked it a lot. Is that still something you like a lot, or?
Oh yeah, I love. Yeah, I didn't plan to write it that way, but it just kind of, it was the holidays. You kind of, you have a little more flexibility. Things are a little slower to write about different things. So like I wrote about Shopify. I talked about kind of like long-term trends as far as like influencers and, mental health and how to handle sell-offs and markets. Like I love writing about topics like that. And I'll probably continue at some point writing about those again. I just need to carve out some ideas to actually finish. I mean, there are actually some ideas I probably should just finish.
Yeah, I think you also wrote about like Twitter, which is both a little bit of an event-driven thing, but also a long-term, really great asset.
Yeah. I think that was a fun one to write about too. But that was definitely much more of there's no catalyst here right away, but here are some kind of North Star concepts to keep an eye on.
With Elliot coming on the board there, I thought your insights on that were great. That was cool. And with the North Star, what do you mean by that?
So when an activist or when new investors come onto the board of a company, especially in a situation where maybe it's potentially adversarial, there's some friction. They're coming in there with an agenda, right? So we talked earlier about, the best thing to happen is for it to happen behind the scenes and everyone is happy. Well, if it gets adversarial, you're showing up with a specific plan in mind or specific agenda items. I call them North Stars in the sense that these are things that we want to implement at the board or governance level, and hopefully it trickles down to help kind of reset the direction of the company to this new, like what we feel are important North Stars to follow, right? I don't know, like Elliot, I think they have a big investor day coming up. I haven't really followed the situation recently, but they haven't clearly communicated what their agenda is. They've kind of hinted, but over time they should start kind of disclosing. You should start being able to see Elliot's influence in the company over time.
Right, because Twitter was like really focusing on like active users or something like that, like a really tech metric.
Well, I think a good example of this is so here's the North Star example with Twitter. When Twitter initially did certain guidance going into this year, they guided about 20% expense growth without any sort of visibility on top line. And when Elliot got involved, it's a subtle note, but they ended up disclosing, hey, this is our expectations on user growth, right? And it kind of aligns with the expense growth. So that was kind of one of those things where it's like, before they didn't really share with that, and it was like, okay, well, why are you growing at such a high expense rate? Like you can kind of assume that they had some aggressive growth assumptions internally, but they weren't sharing it. Elliot got involved and said, if you're going to grow it this way, you have to have some public, North Star or guidance to justify this rampant spend to hold you accountable, right? Like we know you have this internal plan, but like verbalizing it, saying it out loud is a key part of building that long-term partnership with shareholders that also drives that accountability, where it's like you do not have the right to have these audacious plans internally and not share with your investor base, but only share like the expense side, right? Because it's like that's a selective disclosure. So that'd be an example of like introducing certain North Stars. Like we now have a philosophy of transparency and accountability, where if we're going to talk about growth or investment initiatives, we should have some framework on upside that we can share so that investors can track progress there.
Yeah. So it's actually like real basic stuff. I think we know that this works with like small entrepreneurs. Like it's one of the most best things you can do to coach or something, like setting the goals and just checking in. But so that also works with like huge companies. So that's one thing you can do as an activist. It's cool.
Well, especially in tech, you think huge companies 10 years ago were small entrepreneurial operations. So you almost have to remind these leaders that, you're a billionaire, you operate one of the most influential companies on the planet. We love your product sense, but the rest of the philosophies and capital allocation and everything else has to kind of catch up to the reality that you are big, right? You're very big. I think a lot of investors have a similar journey where you have these small upstart funds that are scrappy and they do certain things, and before you know it, they're worth billions of dollars. They manage billions of dollars. They actually have a lot more access or opportunities than they realize. And it's like you kind of have to remind them, like, you're not a tiny fund from 10 years ago. You can behave like a big fund,
Right. Oh, that's cool. So you mean like just demand meetings or something, or
access to meetings, or like actually being constructive on giving feedback to management teams. For us, more smaller scale investors, like, we may look at a situation, go, that's interesting, I'll hold off until we see X, Y, and Z, and then we'll revisit. Well, that mindset more often than not carries, so that when you're big, you say the same things, and I have to go, wait a minute, like, you're big. You can actually go, you don't have to wait till X, Y, and Z. You can actually tell them, we'd like when do you plan on achieving X, Y, and Z, or like, how do you think about X, Y, and Z? You can actually be more constructive and engaging with these teams, and don't be afraid to like use those. I mean, this is a nice problem to have, like, manager. Not many folks get to do that, but in tech, entrepreneurs, founders, they still think they're this Series A, Series B company. They're growing, they're trying to grow really fast, but at some point, when you're dealing with hundreds of millions of dollars in cash flow and billions in valuation, it's like, maybe it's time to kind of implement, some new concepts that you didn't have to really address in the past, but now's the time to kind of, go through those, often they're growing pains, right? So it's definitely interesting.
Yeah, super interesting. Mike, I should really let you get back to your things. I want to thank you so much for being on. It was fascinating listening to you. And please tell the listeners, where can they find you and read your newsletter? Where there's a lot more.
So I'm on Twitter. You can find me at Non-GAAP on Twitter, or you can find me on Substack, which is nongap.substack.com. Feel free to message me. My DMs are open on Twitter. I think that's the best way to get a hold of me.
Cool. Thank you so much, and have a nice day.
Yeah, appreciate it.